Good morning, everyone. We'll just give it a few seconds for more people to sign on here and join us. But we really appreciate you guys being here with us. We're very grateful to be here with you and very glad to be here as well. We're very excited about today because we'll share just briefly on the markets. It's kind of been a hot topic to start this year, along with kind of the political ideas and divisions, as we all know, because the media is getting better and better at bringing us to that. But also a main emphasis that we'll be sharing with you today is different tax planning ideas. We always talk about in our meetings, and just a philosophy of ours in general is that investments are a matter of opinion. Financial planning and these tax planning ideas are a matter of fact. So really excited to go through with you. Peter will be sharing a few items for the contribution limit changes for 2025. Michael, a few miscellaneous tax planning items when it comes to indirect rollovers and sharing some learnings with the 529 to Roth. It sounds very simple, but it's kind of clear as mud. So we've seen it kind of start to finish recently. He's got some good insights there. Ben will be sharing a few RMD and QCD items. And Ashley Money Moves has some great money saving tips for us, and Lauren will be sharing some happenings. So as you guys know, we always start this webinar by going big. I have a lot to be grateful for this week, as always, but my dad celebrated his 80th birthday on Monday, on St. Patty's Day. So a very big milestone and very fun to give him a call and chat through that, and had a couple calls with him with Wes in my arms. So grateful for technology with FaceTime as well. And lastly, my biggest gratitude this week is the appreciation for my wife and what she does for our family that you sometimes don't realize until she may step away for a day. And she took a day and did some solo dadding and parenting. And it was a very big taste of humble pie of how much I really need her and how much she supports our family. So with that, Peter, how about yourself? What are you grateful for today?
Thanks, Zach. First of all, grateful to be out from behind the scenes and live with everyone this morning. But secondly, just thankful for the upcoming, hopefully permanent change in the weather. We had a little taste of it the last week, but just getting back to our daily walks with Maddie after the work day and also being able to spend some time outside at parks, take her to the zoo. So looking forward to a nice summer outside.
Thank you, Peter. How about Ben? What are you grateful for today?
I'm grateful also, Zach, for my dad, to get a chance to spend some time with him. He does a fun little thing with his buddies every March Madness where he pick teams and whoever has the most wins comes out the winner at the end of March Madness. And he has the last couple of years invited me to be along for that ride. So just being able to sit with him and his friends and hear how he interacts. And it's just really cool to be able to spend some time with them, which I don't get to do as much anymore. So that's what I'm grateful for.
Absolutely. I love it. Thank you, Ben. How about Michael? What are you grateful for today?
Thank you, Zach. My gratitude today actually goes out to Ben Renicky on the call. He's a newer member of our team, but about a week and a half ago, he passed his Series 7 exam, which I know he studied very hard for. So just wanted to wish him a congratulations and as well thank him for the positivity and energy and life he's brought to the team.
Thank you, Michael. I 100% agree with that as well. Very exciting. How about Ashley?
Thank you, Zach. I'm grateful, much like you. I had a family member celebrate a birthday on St. Patrick's Day. My oldest son, Andrew, turned 11, so I just cannot believe the time has gone by so quickly. And when they say time flies raising a family, it is true, even though at moments it seems like it does not. So just putting that out there for everyone. And tonight I look forward to celebrating a professional award that my husband is being given, and just looking forward to celebrating with all of those that are joining us. Back to you, Zach. Thanks.
Thank you, Ashley. Yeah, amazing and cool that they share a birthday, and also we're very proud of Alex as well. Amazing accomplishment that some of you guys may read about or see from the city of Milwaukee. So very exciting there. How about yourself, Lauren?
Yeah, thank you. I am grateful for volunteer opportunities. I recently got to volunteer at a camp with Next 18. They're an organization providing mental health support and holistic life resources through the game of golf for vets and first responders. So I'm grateful for the opportunity to have seen a camp from beginning to end and its impact on the people that attended it.
Thank you, Lauren, and thank you for maximizing the give it portion of what we do, which is very exciting to share and hear about as well. Before we go into the tax planning items, just kind of wanted to give an update, just like normal in regards to markets. The media is doing an amazing job of making it seem like the annual end of the world, except consistently every single day. And it just is a great reminder of the timeless pieces that we focus on here. And really, I was just sharing with someone yesterday that was a little bit younger and, was put in money for a 2024 Roth contribution, is wondering if they should wait to put in their 2025 Roth contribution. They're in their 20s and just shared there's really 3 timeless principles to not make mistakes in investing long term. The first one is economies and markets cannot be forecasted or timed. There are no future facts. Second one, the best time to invest money is when you have it. The best time to take money out is when you need it. So it was really fun to share that. And it really goes back to letting the plan drive our investment decisions, not the markets, not politics, not our emotions or other factors, really having the plan drive it. We've been very blessed to have very smart investors with us, and a lot of them have called in to actually get money to work over the last 2 weeks, which is very exciting to hear. That's the Warren Buffett: when others are fearful, be greedy; when others are greedy, be fearful. And it's a great thing that that's the case, but we always talk about patience and going back to the plan. If that cash was there for protection or to bridge income for a year or to keep income low for a year, we may not want to get that to work in the markets and fluctuating with the markets at this time. So we always go back to the plan. The other side of it is, even though the media is doing a great job of getting everyone kind of riled up and freaked out, the average intra-year decline of the S&P 500 is over 14%. So every single year since 1914, the average intra-year decline is temporarily down 14%, even though during that time, the average annual return where the markets ended up is actually over 10%. So every single year we see this volatility. It's just the media is getting better and better at bringing it to us. So the Dow Jones temporarily down right around 2%, 1.9. The S&P, the top 500 companies in the world, is temporarily down 4%. The NASDAQ, a little closer to 9. If you guys remember, the NASDAQ is 50% weighted towards technology. So a lot of kind of this correction conversation or the biggest movements have been in those big technology companies. The Russell 2000 is right around 8%. And this is very exciting for us to share this time, because diversification and asset allocation to start this year is working extremely well. The international side of investing and the asset allocation side is that it's up 8.55%. Emerging markets, which have struggled for 5 to 6 years, really since COVID, is up 6.26. So really what that's saying is that a diversified strategy is working extremely well, combined with rebalances done last year, because if the large technology companies are the ones that aren't doing as well this year, that's what we would have been trimming off of last year through rebalancing. So it's just so exciting for us to see that our timeless pieces, the asset allocation, diversification, and rebalancing is working so well to start the year. So can certainly be more volatility ahead. We can have a 20% correction at any time. We know that. That is necessary and normal for the long-term plan. The only thing we can't do to detriment our long-term plan is to make a bad decision when we have those substantial corrections. So we're always ready. We're always doing lifeboat drills like we talked about in the previous webinars, but just wanted to share that with you guys as well. So kind of shifting gears a little bit from markets to the planning side. Peter, why don't you share a little bit of the changes for contribution limits to retirement accounts for 2025?
Yeah, absolutely. Thanks, Zach. And before I get into that, I did notice that one of our clients who is on this morning is celebrating a birthday today. So just want to wish John a happy birthday, since he's on and listening to us this morning. But yes, I will love to hop into what we are looking at for 2025 in terms of contribution limits. First, a reminder that we do have about another 4 weeks if you are intending to make a 2024 IRA contribution. We have until Tuesday, April 15th to do that. If you're under the age of 50, that amount is $7,000. And if you are over the age of 50, there's a $1,000 catch-up provision. So you can actually contribute $8,000 for your 2024 traditional and or Roth IRA contributions. For 2025, those numbers actually did not change this year. We saw an increase from 2023 to 2024, but 2025 levels will remain the same. So again, under the age of 50 is $7,000, over the age of 50 is $8,000, thanks to that $1,000 catch up. Where we did see a change for 2025 is in our retirement plan contributions. So a couple of changes here. One, under the age of 50, it was increased $500 to $23,500 being the max you can contribute for 2025. Then we saw the additional catch up for 50 over, plus there is a new super catch up provision for anyone that is the age of 60, 61, 62, or 63. So for anyone 50 to 59 plus 64 and over, your amount is $31,000. If you fall into that 4-year age gap of 60 to 63, your number is $34,750. They like to make things confusing. We don't know why it stopped at age 63, but if you happen to fall in that sweet spot, you get to put a little extra away this year if you'd like to. So that is the update for 2025. I'll send it back to you, Zach.
Thank you, Peter. The IRS consistently does a great job of making things confusing for us as far as the ages that they set and the amounts that we set as well. How about Ben? What should we know about required minimum distributions and how it pairs with a few other tax planning items?
Absolutely. Thanks, Zach. Yes, as Zach says, the IRS sometimes makes things confusing, and they also want their money. That's exactly what the RMD is built in for. Those are retirement dollars that you had put in and worked hard to save for. They want their money now because that was all tax deferred. Now it's time to pay the piper. So that's what why we have the required minimum distributions, which is the RMDs, and this is only for traditional IRAs. So for those age 72, if you were born it's age 72 if you were born before 1951, you need to start taking RMDs from your traditional IRA. IRS did change it recently, where for those born 1951 and earlier, that age is now 73. So that's the new age, is 72 for before 1951, 73 for those born 1951 and earlier. And the first RMD, your first year that you take, at the latest, you have to take it by April 1st of the year after you turn RMD eligible. Every other year, you have to take it in the year that year. You cannot postpone it any longer. With that being said, too, even if you are still working and you are that age, you still need to take your RMDs as well. And the caveat is, what if I don't want to take it? Well, you can. However, there's an additional 25% penalty on top of that amount that was required to take out if you didn't take out your RMD amount for this year. With that being said, though, hey, I don't have a necessary need for it. And as Zach said earlier, our give it part of what Gentian believes in, there's what's called a QCD option for you, qualified charitable distribution. This is a tax-free donation towards a charity that can be given directly from your IRA. This is able and eligible for those 70 and a half and older. For those that are RMD age, though, this can count towards your RMD. So if you make a charitable distribution from directly from your IRA, it counts towards lowering that RMD amount and can satisfy it as well. The limit, though, for it is $100,000 for a single filer, $200,000 if you're filing jointly. So that's the QCD update and RMDs. Zach, back to you.
Thank you, Ben. And QCDs have been a major planning tool in our planning quiver, if you will, or in our planning toolbox, especially since the Tax Cuts and Jobs Act in 2017 that raised the standard deduction. A mistake that people often made or that we saw in the industry is that people would take a distribution from their IRA, pay taxes on it, and then give that cash through a check to a church or charity and not get an actual itemization or a taxable benefit for it because the standard deduction was greater than what they itemized for. So the QCD is an amazing tool to give directly to charity and pay no tax. And along with the required distribution, we often get asked, well, I don't need this money at all. Can I do a Roth conversion of the entire amount? And We would love to, that would be amazing. Unfortunately, the IRS makes us satisfy that required distribution first before we do any type of conversion. So the QCD directly lowers what we have to take out for our required minimum distribution, but a Roth conversion can only occur after the entire required distribution is satisfied. So a lot of complex rules, but they work really, really well together. So with that, Michael, what do you have for us on your end?
Thanks, Zach. This morning, I just wanted to touch on a couple of topics or scenarios, if you will, that I've actually ran into in the last month. The first one is a rule that says you can only do one indirect rollover from one IRA to another per year. Want to make a really clear distinction here between account transfers and direct rollovers. The big difference in an indirect rollover is taking possession of the funds. So a lot of times when you roll over your 401k, they may mail you the check directly, but that check can be made payable to your financial institution for the benefit of your name, which in that case, it's not an indirect rollover, so not the topic we're discussing today. But the rule states in a 12-month period, you can only do one of these indirect rollovers once in a 12-month period. Whether it's for a traditional, a Roth, SEP IRA, it makes no difference. This can happen in a lot of scenarios if you have an IRA account at banks where it's invested in a CD, where what we're seeing now is CDs from 3, 4, 5 years ago are at really low interest rates. So a lot of people are trying to get out of that investment, either liquidating or surrendering the CD. And then ultimately it turns to cash. So the easiest way to transfer that from one place to another is just to cut a check and make a deposit there. That's what we call an indirect rollover. And if that does happen, ultimately it's something that you can't undo at that time. So if you're in this scenario, if you've heard somebody in this scenario, please have them reach out to us. The penalty for not fixing that is 6% of the amount that's left in those retirement accounts per year. So it's a pretty big penalty to not do anything about it, but very specific situation there. The second topic I wanted to touch on today, which isn't brand new for 2025, but actually brand new for 2024, which is the 529 to Roth IRA rollover. So where we run into this a ton right now is people that are saving for children or their grandchildren's education and putting money into a 529 account. And the big question they have is, well, what ultimately happens if we put a bunch of money into this account and they ultimately don't go to college and there's funds in this account that they can't use? So one option would be that you can actually transfer those funds to a sibling or another family member for them to use. But in some scenarios, that's not an option. So in this, what changed from last year, some of those unused 529 funds can actually be rolled over to a Roth IRA, subject to plenty of rules, of course. So the first rule is that account, the 529 account, has to be open for at least 15 years and has the same beneficiary on that account as the Roth IRA. The most you can do in one particular year is subject to the IRA contribution limit. So for this year, as Peter mentioned earlier, that'd be $7,000 you can move from the 529 to the Roth IRA tax-free. So if you want to talk about this a little bit further, if one of these topics applies to you, please reach out to us. We're happy to talk with you to make sure that we're doing our best planning work. Thanks, Zach.
Yeah, thank you, Michael. And as I mentioned in the beginning, it sounds very simple. Oh, I can move unused $529 to a Roth IRA up to $35,000. Easy, right? And then as we've went into details on it and see it in practice, it is not so easy. Just as far as determining, you have to have earned income for that child as well. They have to be eligible to contribute to a Roth IRA. And some of these different laws and processes of how it goes from the 529 to the Roth is dependent on the state plan for the 529 as well. So Michael's done quite a few EdVest ones, and we've gotten to a point where we've simplified that process. But if you had an American Funds Virginia plan, as an example, it may be a little different. So it's just kind of taking a pause, making sure we're making the right decisions and there's not any issues with how we're doing it. So great point, Michael. Love that one. the other side of it is great that the IRS came up with a way to use these unused 529 plans as well. So before I go into a few other tax planning items that I had here to share, we'll actually go to Ashley's money moves on how we can save a few dollars today.
Yes, thank you, Zach. So today our team brings to you a mortgage savings idea. You yourself may have already paid off your mortgage, but this is a great tip or potential advice offering to your kids, grandkids, or just others that you know in which this conversation comes up. So I'm going to go ahead and share my screen with you. Hopefully everyone can see that. So by making bi-weekly mortgage payments, you effectively make one extra payment each year, which obviously then reduces your principal much quicker. And it also can save you a significant amount in interest over the lifespan of that loan. So for example, let's say your kids just found a new home. They have a 30-year mortgage. The home itself was around $500,000. Current interest rates, let's say they got 6%. Roughly over the lifespan of this loan, if they make those bi-weekly, again, every 2 weeks, they are making a payment, which gives them one extra payment a year. It will shorten the loan itself by 4 years, and it will also save them approximately $55,000 over the course of that new mortgage. So again, this is just a great savings tip. If you have someone near and dear to you that you'd like to offer this advice, save them some money as well as some time on their mortgage. So that's all I have for you today, Zach. Thanks, and back to you.
Thank you, Ashley. This is a great one, and we spent some time with behind the scenes. We're always working with centers of influence, accountants, estate planning attorneys, attorneys in different areas of practice, health insurance specialists, and also lenders in real estate. And we went through a meeting with a few lenders directly with the client to help them purchase a home, and we were analyzing the impact of a 10-year loan, 15-year loan, 30-year loan. And we found through an amortization schedule that if you add one extra payment a year, goes from a 30-year mortgage to a 23-year mortgage. So if you combine that with Ashley's idea as well, very quickly a 30-year mortgage gets dropped down quite a bit. And just since we're talking about mortgage real briefly, a consensus from a lot of those lenders we've talked about is that there's a very real possibility in the next 18 months that 7% mortgage could be closer to 5%. So if you've recently purchased a home and you have it at 7%, just keep an eye on those. You might have an availability to refinance at some point at a rate that makes sense. But I'll never forget 10 years ago when I first got into the industry, shared that 80% of the time they guessed the wrong direction of interest rates, let alone by how much it goes down. So just an idea, it may or may not happen, but that's kind of what we're hearing consensus wise, is that over the next 18 months, we could see rates in the 5% range again. So before heading over to Lauren to hear all the things happening here at Gentian and you should know about, just wanted to share two kind of tax planning items that we've seen the impact of recently. One of those to the Give It side, along with the qualified charitable distributions that Ben mentioned. Another great planning tool that we have here for charitable giving and smart charitable giving is what's called the Donor Advised Fund. And it's really to simplify it and just to explain it very briefly, it's really just bunching multiple years worth of contributions that you're giving to church or charity into 1 year, getting a sizable deduction in that 1 year, and then dispersing it over time. When you disperse it, you don't get a tax benefit or a write-off for your taxes, but in that year where you bunched them all together and donated to the Donor Advised Fund, you get that full deduction. You just want to work very, very closely with us. Raymond James has Raymond James Charitable, and it works very seamlessly back and forth. They have a great online platform for it. But we'll also want to work very closely with your accountant with that as well, because it depends on what type of asset we're giving to that Donor Advised Fund as far as how much we can actually write off. If you give in cash, it's really only deducting up to 60% of your adjusted gross income. If you give appreciated securities to the Donor Advised Fund, it's actually only 30%. So working very closely hand in hand with us and the accountant to make sure that that's a smart decision. And that's calendar year. That has to be done by December 31st to get credit for the current tax year. The last one, just wanted to touch on, we've come across a lot of scenarios recently. Unfortunately, a few of our of our clients passing away over the last 4 months, and we've been at quite a few funerals, so it's an honor to respect them. But the idea of inheriting assets is becoming a very big talking point, either that's being received or preparing the money for the next generation. And we had one recently where husband unfortunately passed away. The spouse was a primary beneficiary, and I won't name the name of the company, but the back office was going to cut her a check for the traditional IRA. It was a few $100,000 that would have had to pay taxes in the current year on the entire amount. And I was kind of like, whoa, 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 hold on. Let's take a look at making sure that's an inherited IRA where there's no tax. And if a spouse inherits the IRA from the other, you have a choice to leave that as an inherited IRA or actually put that in your own name and make it part of your IRA. So it depends on the ages of both. But if something, heaven forbid, happens and somebody in your family passes away and you're entitled to certain assets, we like to be the quarterback of the team, working with the accountant, the attorney, to make sure that's properly and is really smart tax wise. Or if something, heaven forbid, were to happen to you guys, we are here for your family to help make those decisions. The rules are very, very complex, depending on the assets that are received by that next generation, whether it's retirement account assets or non-retirement account assets. They all have different rules and different things to look at. So a sad one and a very eye-opening one that sometimes back offices, some places, depending on where an IRA is held, might automatically send a check for something that they should not send a check for. So just a great reminder there to just take our time and make smart decisions. With that, Lauren, let us know what's coming up here at Gentian we should know about.
Sounds great, thank you. So staying on the topic of taxes real quick, I just wanted to mention that all final tax documents have been mailed out by Raymond James by now. So everyone should have gotten their 1099s, or they should be on their way to you, as the last and final batch was mailed out on the 15th. And then looking into April, we actually have 3 of these biweekly video podcasts, and each of them have their own topics. So starting on Wednesday, April 2nd, the biweekly video podcast topic is it's Financial Literacy Month in the month of April. So we're going to talk about budgeting, saving, investing, and managing debt. And then looking at Wednesday, April 16th, another biweekly video podcast. That topic is risk versus return, the importance of diversification. And then that same day, April 16th, is our April birthday club. So if you have a birthday in the month of April, please join us in celebrating your birthday. And you can RSVP for that on our website. Friday, April 18th is Good Friday, so all the markets and our office will be closed. Tuesday, April 22nd, we actually have a volunteer opportunity at the Domes. So we'll be doing a spring cleanup, and it's going to involve a lot of gardening. So if that resonates with you, feel free to join us, as we're looking for a few more volunteers for that day. April 23rd, that is our spring technology workshop. You can RSVP for this, and it is required. So don't miss that, because we're going to have a lot of fun topics on technology to discuss at that workshop. And then lastly, Wednesday, April 30th, our 3rd biweekly video podcast of the month. That topic is emergency savings, and we're going to discuss what the recommended amount for that would be. And that is all I have for now.
Thank you, Lauren. Really appreciate it. As always, a lot happening here, and we try to give you as many consumables as possible to benefit you and your family. And we try to really listen closely in meetings to bring the top talking points to you. And Lauren mentioned the 1099s, and I just received feedback recently from an accountant that assists quite a few of our clients, and they said that Raymond James 1099s are the clearest and best that they receive. So that's nice for us to hear, especially when there's sometimes delays, and those delays can be frustrating. Raymond James really wants to make sure that they get those right, so you don't have to go back and amend those. So we always recommend waiting until that March 15th for those, if you have a non-retirement account that produces a 1099. But it was really nice to hear from an accountant that the 1099s we receive are very clear and easy to use from them, because we don't see a lot of other firms 1099s all that often. As Lauren mentioned, Chris just got back from Abundance 360. He was able to download with us. That's 360 of some of the top business people in the world going through all of the technological changes that are occurring. And it's always fascinating to hear what he comes back with. And we can't wait for him to share that with you. It's really amazing what people are working on. And we can be fearful or optimistic about it. And you're both probably right, depending on how you feel about it with all the changes coming. So with that, just thank you so much for your time this morning. We've been very, very blessed with introductions from you. Thank you so much for your transfer of your trust. It's an honor to serve those people that you introduce to us and work with them, and it's an honor to work with you. So thank you so much again for your time today, and hope you guys have a great rest of your week. Thank you.